Hey guys, today I'm talking about cash flow forecasting. So the main thing I'm going to talk about today is when you're starting a business, how much cash are you going to need to start that? But this is also a really good video for any sort of cash flow forecasting. So watch it if you're looking just to up your cash flow forecasting game for your business, and make sure you watch to the end because I'm going to tell you why you need to ask for more cash than this is going to show you. So be sure to stick around for that. But first, I'll start with just what are you trying to do with cash flow forecasting? The first thing you're looking to do, especially when you're starting your business, is to know just how much money you're going to need so you don't run out of cash. Running out of cash is about the worst thing you can do in your business, because if you have employees or you have suppliers and you can't pay them, it's going to cause you a lot of trouble. Not to mention paying the taxes that you owe and payroll and sales tax and all that kind of thing. So absolutely 100% need to know how much cash you're going to need to start your business. And this is the easiest way to show you how to do that. So I'm going to pull in over here and show you this spreadsheet. So, first thing you're wanting to do when you are forecasting for your new business is to know what sort of investments you're going to have to put in at the beginning. So, I call this time zero because it's before you open your doors, and you're going to want to look at the total outflows that are going to go. So these are just some examples, but definitely add any that you need. And in this, I will say, so Paul's Pottery Palace, this is our sample. You're welcome to this. You can just open this up file and make a copy, and you can save it to your own Google Drive. I will share the link down below, and that's totally free. But you can also add in any rows and columns. I'm right clicking there, and you can insert a row up or below. So that's where you want to make sure you know what cash flow is going to go out in when you're starting your business. The next piece you're going to want to know is your operating outflows. So the key here is don't get too precise. I think people get bogged down in thinking they need to be super precise about all of these things. I think you want a general sense, see if you can back it up with a bit of research, but definitely don't bog yourself down with getting too detailed. So here again, we've listed some common ones that you'll see in operating expenses, but you can add in more, delete some out if they're not applicable to your business. That's all good. So that's the second place you'll want to fill out. Make sure this, like I've got one here just for the year, but you can change these dates and add more into the other side here. So that's number two. So number one, you're wanting to figure out what you need before you open your doors. Number two, you want to figure out what your operating expenses are going to be, and you can just easily pull these over. If you just use this little square here, you can pull that over and it'll fill all the way over and add 250 to all those columns. So don't enter them individually unless you don't have anything better to do. All right. So now that we've got our cash outflows in time zero, our monthly cash outflows, we want to focus on where we're going to get our money from. So number one, how much savings do you have? All the money that you have at the moment before you're opening your doors. And we're going to figure out what the shortfall is later. But list anything that you can rely on for different loans, family loans, your own investment and your savings, and other loans for maybe government organizations or that. So that's a place to start. And then this is the trickiest bit. So before you open your business, or even when you're running your business, forecasting what your sales are is really difficult. There's ways to go about this, and I recommend that, if you want to break it down even further, you can sort of insert some rows here. So let's insert 5 rows above. That's going to be generous. But if you wanted to forecast sort of product sales, maybe you have product volume first. So you're going to know how many units you sell, and you're going to know price. So you can enter in, you're going to sell 500 items this month, and you're going to sell them for $20 a piece. Now your product sales are going to be equal this times this. So that's just another way to go about it. Not necessary to do it that way, but if you're more confident in how many items you're going to sell versus what the revenue is going to be, that's a good way to go about it. But for simplicity purposes, I'm just saying your revenue for each month and you enter them all the way across. So if you have different lines of products, you can enter them here and again add more lines as you need them. So once you have all this data in here, so you have your inflows and outflows before you open your doors, and now you have your operating first year of operations going on. This is all we've created all these calculations, but what you see here is your net inflows and outflows per month as you start. So in January, you had $10,000 going out the door, almost 11,000 going out the door, and that number is reducing, kind of fluctuating throughout the first 3 months, and then we see a spike in some sales over here, and now you're cash flow positive. So the idea down here is to show what your running cash balance is. So as you'll see, we have our monthly cash flow here, what we started with the month here, and then what we ended the month with here. And so what we've formulated in here is that the lowest cash balance that we see is the shortfall you need for investment in day one. So you don't want to be worrying about this come August. You want to worry about this when you're opening your doors. So the key here is that you'll want to make sure you have an extra bit of investment. So if I said, okay, well, we're going to get a second loan, bank loan here. Bank loan for $25,000, and now you see that's a positive. That's a good thing. So now we haven't run out of cash. We're never in a negative cash situation. That's what we're looking for. But as you see, if I delete that, now we've got some negative cash balances, and the lowest is $21,655. So that's the investment that you'll need. So that's really the basics of cash flow forecasting. It's not any more complicated than that. You can make it as complex as you want with when you're buying inventory and all those things. But what I'll say is that in the beginning, you want to keep it simple. And as promised, I'm going to say why you need to ask for more money than is shown here is that there's a lot of things that can happen. So number one, expect the unexpected. Your sales may not come in, and you may find out that your employee wages are $8,000 this month, or somebody leaves and the next person you hire is demanding a bit of a higher salary. Something. Expect the unexpected is the point, and that these cash flow outflows always seem to work in the way you don't want them to, especially in the early days. So make sure you build in a buffer for that. The next point is that cash matters, not sales. So although these are your sales numbers here, this might not reflect when cash is coming in the door, especially for service sales. Maybe you did $7,500 in services, but they're not paying you until this month. Well, now you've got a problem because you forecasted that cash will come in for that, but it's not arriving here. So you're a little delayed on getting that cash in the door. So that's a big thing that people miss. It's called accounts receivable, and it can be 30, 60, 90 days. So next, our monthly balances are only part of the equation. So maybe all your expenses go out the door on the first of the month and all your income comes in on the 30th of the month. This won't show the full story. So what we try to say is that if you're going for investment, ask for a lot more than you need. Another half almost is recommended, because you never know what's going to happen in the first year of your business, or in any year of your business, really. So having a buffer for cash and not missing things is the way to go. So that's it. That's cash flow forecasting in a nutshell. I hope you enjoyed this video. If you did, please comment below and download our free template here that we have. Reach out with questions. We'd love to answer them. Thanks for watching, and we'll see you next time. Cheers.